Question 1. The primary purpose of a variable annuity separate account is to hold the investments that fund the A. Insurer's general expenses. B. Guarantees of the fixed annuity option. C. Investment returns for the contract owner's accumulation units. D. Minimum guaranteed death benefit. Answer: C. Investment returns for the contract owner's accumulation units. The separate account holds the investment portfolio for the variable annuity, and its performance determines the value of the accumulation units during the pay-in phase and the ultimate income stream during the annuitization phase. Since the separate account's performance is not guaranteed, it must be registered as an investment company, and the contract owner assumes the investment risk. Unlike a traditional fixed annuity, the separate account is where the customer's money grows tax-deferred, directly reflecting the performance of the underlying sub-accounts chosen. Remember that variable products are securities because the customer bears the investment risk, and the separate account is the mechanism for that risk. Question 2. A mutual fund's public offering price (POP) is calculated as the net asset value (NAV) per share. A. Divided by 1.0 minus the sales charge percentage. B. Plus the sales charge per share. C. Multiplied by the sales charge percentage. D. Plus the 12b1 fee. Answer: B. Plus the sales charge per share. The public offering price (POP) represents the total cost to the investor to purchase a share of an open-end management company or mutual fund, and is the net asset value (NAV) per share plus the sales charge. The NAV is the fund's asset value minus liabilities, divided by the number of shares outstanding, representing the book value, and any front-end load is then added to establish the price the public pays. For example, if a fund's NAV is $9.00, $9, and the sales charge is $1.00, $1, the POP is $10.00, $10. Remember the equation: NAV plus sales charge equals POP. Question 3. Under FINRA rules, what is the primary factor that determines if a registered representative has exercised reasonable diligence in making a recommendation to a customer? A. The size of the commission earned from the transaction. B. The customer's investment profile and objectives. C. Whether the security is listed on a national exchange. D. The security's past performance history. Answer: B. The customer's investment profile and objectives. The fundamental suitability obligation requires a registered representative to have a reasonable basis to believe that a recommended transaction or investment strategy is suitable for the customer, based on the customer's investment profile. This profile includes the customer's age, other investments, financial situation, tax status, investment objectives, and risk tolerance, all of which must be gathered under the Know Your Customer (KYC) rule. For example, recommending a high-growth stock to an elderly investor seeking capital preservation would likely violate the suitability rule. Always prioritize the customer's needs and profile above all other factors when making a recommendation. Question 4. An investment company that issues a fixed number of shares that trade on an exchange or over-the-counter market is defined as A. Open-end management company. B. Unit investment trust (UIT). C. Closed-end management company. D. Exchange-traded fund (ETF). Answer: C. Closed-end management company. A closed-end management company is characterized by issuing a fixed number of shares only once during an initial public offering, and these shares then trade in the secondary market, much like common stock. Because the shares trade on an exchange, their market price is determined by supply and demand, meaning they can trade at a premium or discount to their net asset value (NAV). In contrast, open-end funds or mutual funds continuously issue and redeem shares, which are always bought and sold at the NAV plus a sales charge, if any. The clue fixed number of shares trading on an exchange is the key identifier for a closed-end fund. Question 5. Which of the following statements about municipal bond funds is most accurate? A. They invest in corporate bonds and are only suitable for high net worth investors. B. The interest income is exempt from federal income tax. C. They are subject to substantial interest rate risk and credit risk. D. Capital gains from the sale of shares are tax-free at the federal level. Answer: B. The interest income is exempt from federal income tax. Municipal bond funds invest in debt securities issued by state and local governments, and the primary benefit of this type of fund is that the interest income passed through to shareholders is exempt from federal income tax, making them attractive to high-income earners. While the interest is tax-free, any capital gains realized from selling the shares at a profit or any dividends from a municipal bond fund are still taxable. The phrase, municipal bond fund, is the key clue, reminding us of the federal tax-free benefit associated with municipal interest. Question 6. All of the following are generally tax-deductible contributions to an individual retirement account, IRA, except A. Contributions made before the tax filing deadline for the previous year. B. Contributions made into a Roth IRA. C. Contributions made by an employed individual under age 50. D. Contributions made by an individual's non-working spouse. Answer B. Contributions made into a Roth IRA. Contributions made to a Roth IRA are made with after-tax dollars, meaning they are never tax-deductible, but in exchange all qualified distributions in retirement are tax-free. Conversely, contributions to a traditional IRA may be tax-deductible, reducing the contributor's current taxable income, while distributions in retirement are taxed as ordinary income. The key differentiator is the type of IRA. Traditional IRAs potentially offer a deduction up front, while Roth IRAs offer tax-free distributions in the future. Always remember the Roth IRA's distinguishing characteristic is its post-tax funding, which provides tax-free retirement withdrawals. Question 7. The Investment Company Act of 1940 requires mutual fund advertisements to include a guarantee of minimum returns over the next 10 years. B. Information on how to obtain a prospectus. C. The exact dollar amount of the current yield. D. A complete list of all portfolio holdings. Answer B. Information on how to obtain a prospectus. Under the Investment Company Act of 1940 and FINRA rules regarding communications, any mutual fund advertisement, known as an omission prospectus or tombstone ad, must inform investors that they can obtain a full prospectus containing complete information about the fund. The full prospectus is the statutory offering document, and a key regulatory mandate is that prospective investors must have access to it before or during the solicitation. This ensures investors have all the material facts necessary to make an informed decision before purchasing the security. The clue is advertisements, which are typically short and promotional and thus must direct the reader to the complete disclosure document. Question 8. What is the maximum sales charge an open-end investment company, mutual fund, can levy on the purchase of its shares under FINRA rules? A. 8.5% of the offering price. B. 9% of the net asset value, NAV. C. 7.25% of the offering price. D. 6% of the net asset value, NAV. Answer A. 8.5% of the offering price. FINRA rules cap the maximum sales charge for open-end investment company shares at 8.5% of the public offering price, POP, if the fund offers three specific privileges: breakpoints, rights of accumulation, and reinvestment of dividends and capital gains at NAV. If a fund does not offer all three of these investor-friendly privileges, the maximum sales charge is limited to 6.25% or 7.25%, depending on the privileges offered. The key is recognizing 8.5% as the absolute maximum sales load permitted on a mutual fund purchase, providing the investor receives the maximum privileges. Question 9. An investor who signs a letter of intent, LOI, to qualify for a mutual fund breakpoint must complete the investment within a maximum of A. 6 months. B. 13 months. C. 18 months. D. 7 years. Answer B. 13 months. A letter of intent, LOI, allows an investor to qualify for a reduced sales charge, known as a breakpoint, based on the total amount they intend to invest over a 13-month period. The LOI can be backdated up to 90 days to include prior purchases, effectively giving the investor 13 months total to complete the promised investment amount. If the full amount is not invested by the end of the 13-month period, the fund will liquidate enough shares from an escrow account to cover the difference in the sales charge owed. The core concept here is that an LOI is a voluntary contract giving the investor a little over a year to reach a lower sales charge tier. Question 10. Which characteristic is unique to a unit investment trust, UIT, compared to a management company? A. It has a professionally managed, actively traded portfolio. B. It issues redeemable shares. C. It is a registered investment company. D. It has a fixed portfolio with a specific termination date. Answer: D. It has a fixed portfolio with a specific termination date. A unit investment trust, UIT, is known for its fixed, unmanaged portfolio of securities, and once the securities are selected and placed into the trust, they are generally not traded. Furthermore, a UIT is a self-liquidating investment, meaning it has a specific date when the trust is designed to terminate, and the remaining assets are distributed to the unit holders. Management companies, either open-end mutual funds or closed-end, feature an active, changing portfolio managed by an investment advisor, making the fixed portfolio and termination date the defining clues for a UIT. UITs are established to hold their investments until a specified maturity or liquidation date. Question 11. When a variable annuity contract holder makes the transition from the accumulation phase to the payout phase, this process is known as separation. B. Annuitization. C. Surrender. D. Reinvesting. Answer: B. Annuitization. Annuitization is the process where the accumulated value of a variable annuity, represented by accumulation units, is converted into a stream of periodic income payments. This conversion involves exchanging the accumulation units for a fixed number of annuity units, and once the decision to annuitize is made, it is generally irrevocable. The clue, transition from accumulation to payout, directly defines the term annuitization, which signifies the commencement of the income payments. The variable annuity is now fulfilling its primary purpose of providing income during retirement. Question 12. A registered representative must obtain all of the following information when opening a new cash account for a non-institutional customer except: A. The customer's investment objectives. B. The customer's financial status and tax status. C. The customer's signature on the new account form. D. The customer's name, address, and date of birth. Answer: C. The customer's signature on the new account form. While a customer's signature is generally required for options accounts or margin accounts, it is not strictly mandated on a new cash account form to establish the account, though most firms still require it as a matter of internal policy. Essential information that must be collected to satisfy the Know Your Customer (KYC) rule and suitability requirements includes the customer's legal name, address, date of birth, investment objectives, and financial status, enabling the firm to assess suitability. The registered representative's signature, however, is always required, attesting that they have met with the customer and confirmed the information is accurate. Question 13. Which type of investment risk is most relevant to a municipal bond fund? Liquidity risk. B. Political risk. C. Credit risk. D. Inflation risk. Answer: C. Credit risk. Credit risk, or default risk, is the risk that a bond issuer will be unable to make interest payments or principal repayment when due, which is highly relevant to municipal bond funds that hold municipal debt. Although municipal bonds are generally considered safe, the issuing state or local government can face financial difficulties and default on their obligations. Interest rate risk is also significant, but credit risk is the most direct risk related to the issuer's ability to pay back the bond's principal and interest. The key takeaway is that even government entities can default, making credit risk a constant consideration in fixed income investments. Question 14. Which document must be delivered to a customer at or before the completion of any sale of a new issue security, such as a mutual fund? A. Statement of Additional Information, SAI. B. Proxy statement. C. Prospectus. D. FINRA manual. Answer: C. Prospectus. The Securities Act of 1933 mandates that a full, statutory prospectus must be provided to a purchaser of any new issue security, including a mutual fund, at or before the time of sale. The prospectus is the primary disclosure document that contains all material facts about the investment, including the fund's objectives, risks, fee structure, and management team. This requirement ensures that investors receive sufficient information to make an informed decision before committing to the purchase. The term new issue security is the clue that triggers the prospectus delivery requirement. Question 15. The primary difference between a fixed annuity and a variable annuity is that the variable annuity's cash value and death benefit. A. are guaranteed by the insurance company's general account. B. Are regulated exclusively by state insurance departments. C. Fluctuate based on the performance of the separate account. D. Offer protection against inflation with a guaranteed rate of return. Answer: C. Fluctuate based on the performance of the separate account. The key distinction is that a variable annuity's cash value and death benefit, if applicable, vary based on the investment performance of the securities held in the separate account, transferring the investment risk to the contract owner. In contrast, a fixed annuity guarantees both a minimum rate of return and the principal, with the funds held in the insurer's general account. The clue primary difference points directly to the risk-bearing element, making the variable nature tied to the separate account performance the correct answer. Remember, the fluctuating performance means a variable annuity is considered a security. Question 16. The concept of rights of accumulation allows an investor to qualify for a reduced sales charge on new purchases by A. Combining current purchases with a spouse's existing account value. B. Adding the value of prior purchases to the amount of the current purchase. C. Signing a letter of intent for a future amount. D. Reinvesting dividends and capital gains at the offering price. Answer: B. Adding the value of prior purchases to the amount of the current purchase. Rights of accumulation allow investors to use the current market value of their existing shares in a mutual fund, combined with the new money being invested, to reach a higher breakpoint and thus qualify for a reduced sales charge, a lower sales load. Unlike a letter of intent, which is based on a promise of future investments, rights of accumulation are based on past investments plus the current purchase. The core concept is that the fund grants the investor the benefit of a large-scale buyer by aggregating their total investment value. The clue is reduced sales charge on new purchases, which results from recognizing the total account value. Question 17. The maximum duration a customer may use portfolio margin is A. 6 months. B. 12 months. C. 18 months. D. There is no maximum duration. Answer: D. There is no maximum duration. The term portfolio margin is relevant to advanced options and securities accounts, which goes beyond the scope of the Series 6 exam, which focuses on investment company products and variable contracts. Since the Series 6 is a limited representative license, questions about complex margin rules like portfolio margin are generally not part of the fundamental exam content. Therefore, a Series 6 candidate is not expected to know the specific rules about portfolio margin duration. They should focus on mutual funds, variable annuities, and retirement plans. The key takeaway for a Series 6 candidate is to recognize out-of-scope topics and focus efforts on the core products. Question 18. An investment company that continuously offers new shares and agrees to redeem its shares at the net asset value, NAV, is A. Closed-end fund. B. Unit investment trust, UIT. C. Open-end fund, mutual fund. D. Exchange-traded fund, ETF. Answer: C. Open-end fund, mutual fund. An open-end fund, universally known as a mutual fund, is defined by its continuous offering of new shares and its promise to redeem outstanding shares upon request at the current net asset value, NAV. The continuous issuance and redemption of shares means the total number of outstanding shares constantly changes, and the fund's price is directly tied to its NAV. This redeemable feature is the key distinction between an open-end fund and a closed-end fund, whose shares trade on an exchange. The clues continuously offers new shares, and redeem its shares at the NAV, perfectly describe a mutual fund. Question 19. What is the tax implication of exchanging shares of one mutual fund for shares of another fund within the same family of funds? A. It is a tax-free exchange. B. It is a tax-deferred exchange. C. It is a taxable event. D. It is taxed only if a gain is realized. Answer: C. It is a taxable event. Even though the exchange of shares occurs within the same family of funds and the sale of the first fund's shares and the purchase of the second fund's shares often happen simultaneously, the IRS views this transaction as a sale and a subsequent purchase. Therefore, any capital gain or loss realized upon the sale of the first fund's shares must be reported to the IRS, making it a taxable event. A customer who exchanges one fund for another within the same fund family must be made aware of this potential tax liability. This rule is crucial because the convenience of a fund family exchange does not negate the tax consequences. Question 20. Under which condition would a registered representative need to obtain authorization from a principal prior to using a piece of retail communication? A. If the communication will be distributed to fewer than 25 existing customers within a 30-day period. B. If the communication is a static form of advertising that makes a financial or investment recommendation. C. If the communication is distributed exclusively through a firm's internal communication system. D. If the communication has been previously filed with and approved by FINRA. Answer: B. If the communication is a static form of advertising that makes a financial or investment recommendation. FINRA rules define retail communication as any written or electronic communication distributed to more than 25 retail investors within a 30 calendar day period, and if this communication is a static advertisement, it must be approved by a registered principal before first use. Static content, like a website page or a firm brochure, remains unchanged until a principal approves an update, and approval ensures the content is fair, balanced, and not misleading. Conversely, interactive electronic communications may be exempt from this pre-use approval, but any static advertisement making a specific investment recommendation requires principal pre-approval. Always ensure a supervisor signs off on any widely distributed, non-personal sales material. Question 21. If a mutual fund shareholder elects to automatically reinvest dividends and capital gains distributions, which statement is true regarding the tax liability? A. Both dividends and capital gains are deferred until the shares are redeemed. B. Only the capital gains are tax deferred, but dividends are taxed currently. C. Both distributions are taxed as ordinary income and capital gains, respectively, in the year they are distributed. D. Neither distribution is taxable, as the funds remain invested in the fund. Answer: C. Both distributions are taxed as ordinary income and capital gains, respectively, in the year they are distributed. Regardless of whether a mutual fund shareholder chooses to take distributions in cash or automatically reinvest them to buy more shares, the dividends and capital gains distributions are taxable in the year they are paid out. Dividends are generally taxed as ordinary income, and capital gains are taxed at the applicable capital gains rate, based on how long the fund held the underlying securities. The clue is automatically reinvest, which is a convenience feature, not a tax deferral mechanism, unlike retirement accounts. Always remind clients that reinvested distributions are still subject to current taxation. Question 22. All of the following are characteristics of a tax-sheltered annuity, TSA, also known as a 403(b) plan, except A. It is a retirement plan available to employees of public schools and non-profit organizations. B. Contributions are generally made with pre-tax dollars. C. It can be funded only with mutual funds or stocks and bonds. D. It allows for tax-deferred growth on investments. Answer: C. It can be funded only with mutual funds or stocks and bonds. A tax-sheltered annuity, TSA, or 403(b) plan, is a retirement plan for employees of public education systems and certain non-profit organizations, and while it can be funded with mutual funds, it can also be funded with annuity contracts. The key characteristic of a 403(b) is that the contributions are generally pre-tax, and all investment growth is tax-deferred until withdrawal. The clue is TSA/403(b), which is an IRS-recognized retirement plan, and its specific funding options include both variable annuities and mutual funds. Question 23. A registered representative is prohibited from sharing in the profits or losses of a customer's account unless which of the following conditions is met? A. The representative contributes a minimum of 25% of the capital. B. The customer has signed a written acknowledgement of the agreement. C. The firm has provided written authorization, and the sharing is in direct proportion to the representative's financial contribution. D. The account is a non-discretionary cash account. Answer: C. The firm has provided written authorization, and the sharing is in direct proportion to the representative's financial contribution. FINRA rules strictly prohibit a registered representative from sharing in the profits or losses in a customer's account unless two conditions are met. The sharing arrangement must have the firm's written authorization, and the sharing must be proportionate to the representative's actual financial contribution to the account. For example, if a representative contributes 10% of the capital, they can only receive 10% of the profits. This rule is designed to prevent representatives from taking excessive personal advantage of a customer's account activity and to keep their interests aligned with the customer's. Question 24. What is the maximum initial sales charge that can be imposed on the purchase of a variable life insurance policy? A. 8.5% of the total premium. B. 9% of the maximum premium over the policy's life. C. An average of 9% of the premium per year over a 20-year period. D. An average of 12% of the premium per year over a 20-year period. Answer: C. An average of 9% of the premium per year over a 20-year period. Sales charges on a variable life insurance policy are not subject to the strict 8.5% cap seen in mutual funds but are regulated by the Investment Company Act of 1940 to ensure fairness. The maximum sales charge that may be imposed over the life of the policy cannot exceed 9% of the total premium payments to be made over a period not to exceed 20 years. This rule prevents excessive front-loading of sales charges in the early years of the policy, protecting the investor. The key is to remember the 9% over 20 years benchmark for variable life insurance sales charges. Question 25. An investment management company that manages a mutual fund is responsible for all of the following except: A. Determining the fund's investment objective and strategy. B. Maintaining custody of the fund's cash and securities. C. Selecting the securities for the fund's portfolio. D. Executing trades to buy and sell portfolio securities. Answer: B. Maintaining custody of the fund's cash and securities. The Investment Company Act of 1940 requires that a mutual fund's assets be held by a separate custodian, typically a commercial bank, and not by the investment advisor, manager. This separation is a crucial safeguard, ensuring the investment advisor does not have direct access to the fund's cash and securities, preventing potential theft or misuse of the assets. The investment manager is primarily responsible for the fund's investment strategy, security selection, and trading activities. The clue is custody, a function specifically separated from the management company. Question 26. Which feature is generally not associated with a variable life insurance policy? A minimum guaranteed cash value. B. A minimum guaranteed death benefit. C. A separate account containing investment subaccounts. D. A policy loan feature. Answer: A. A minimum guaranteed cash value. Since the cash value of a variable life insurance policy is invested in the separate account and fluctuates based on the performance of the underlying securities, there is no minimum guaranteed cash value, and the investor assumes the investment risk. The contract does, however, typically include a minimum guaranteed death benefit, ensuring the policy does not lapse even if the cash value declines significantly. The clue variable life indicates that the cash value is variable and therefore not guaranteed, which is a key distinction from traditional whole life insurance. Question 27. An investor wishing to take advantage of dollar cost averaging would find which investment suitable? A non-dividend paying stock purchased as a single lump sum investment. B. A municipal bond bought at a deep discount. C. A mutual fund that allows for regular fixed dollar investments. D. A closed-end fund trading at a 20% premium to NAV. Answer: C. A mutual fund that allows for regular fixed dollar investments. Dollar cost averaging is a strategy where an investor commits to investing a fixed dollar amount at regular intervals, regardless of the security's current price, resulting in a lower average cost per share over time. A mutual fund is the ideal vehicle for this strategy because it easily accommodates regular fixed dollar contributions, which are used to purchase varying numbers of shares based on the price. The key concept is regular fixed dollar investments, which perfectly describes the dollar cost averaging technique. Question 28. Which of the following parties is primarily responsible for determining the dividend and capital gains distributions of a mutual fund? The custodian. B. The transfer agent. C. The board of directors. D. FINRA. Answer: C. The board of directors. The board of directors of the investment company is responsible for setting the policies, authorizing all major actions, and declaring the distributions to shareholders, including dividends and capital gains distributions. While the investment advisor manages the portfolio, the board formally oversees the fund's management and operations and authorizes the payments. This is an important governance point to ensure the distributions are properly approved and announced to shareholders. The board acts as the ultimate authority, representing the shareholders' interests. Question 29. The main objective of a fund offering an aggressive growth investment strategy would be A. High current income. B. Preservation of capital. C. Maximum long-term capital appreciation. D. Investment in debt securities exclusively. Answer: C. Maximum long-term capital appreciation. An aggressive growth fund primarily seeks to maximize capital appreciation, often by investing in small-cap companies, emerging markets, or volatile industries, and typically reinvesting any earnings back into the portfolio rather than distributing them as income. The key clue, aggressive growth, signifies a high-risk, high-potential reward strategy focused on increasing the value of the investment over a long time horizon. Investors for these funds are usually young or have a high risk tolerance and a long investment time horizon. Question 30. Which term refers to the sales charge that an investor pays when they redeem or sell their mutual fund shares? A. Contingent deferred sales charge (CDSC). B. Front-end load. C. Level load 12b1 fee. D. No load fee. Answer: A. Contingent deferred sales charge (CDSC). A contingent deferred sales charge (CDSC), often associated with Class B shares, is a back-end load, meaning it is a sales charge the investor pays when they redeem the shares. The fee is typically a percentage of the lower of the purchase cost or the redemption value and decreases over time, often dropping to zero after 5 to 7 years. In contrast, a front-end load is paid at the time of purchase. The clue sales charge, when they redeem, immediately identifies the CDSC as the correct type of fee. Question 31. What is the standard number of days for the settlement of corporate securities transactions, such as mutual fund shares? A. T+1, trade date plus 1 business day. B. T+2, trade date plus 2 business days. C. T+3, trade date plus 3 business days. D. T+4, trade date plus 4 business days. Answer: B. T+2, trade date plus 2 business days. The settlement cycle for most corporate securities, including common stocks, corporate bonds, and mutual funds, is 2 business days after the trade date, often expressed as T+2. Settlement is the process where the buyer pays for the security and the seller delivers the security. While the transaction for an open-end mutual fund is technically completed the day the redemption is processed, for regulatory purposes, the proceeds must be wired to the investor within the standard settlement cycle. T+2 is the current standard for virtually all cash transactions involving securities. Question 32. In the context of a variable annuity, what does the term accumulation unit represent? A fixed number of shares that determine the monthly payout. B. An ownership interest in the separate account during the pay-in phase. C. The value of the fixed annuity component. D. The total number of annuity payments guaranteed. Answer: B. An ownership interest in the separate account during the pay-in phase. During the pay-in or accumulation phase of a variable annuity, the investor's contributions are used to purchase accumulation units, which are an ownership interest in the separate account's underlying investment portfolio. The value of these units fluctuates with the performance of the chosen investments, determining the total cash value. Once the investor annuitizes, the accumulation units are converted into a fixed number of annuity units, which then determine the periodic income payments. The key clue is pay-in phase, where the value is accumulating. Question 33. Which of the following types of investment risk is reduced by diversifying a mutual fund's portfolio across many different securities? Inflation risk. B. Market risk, systematic risk. C. Business risk, unsystematic risk. D. Interest rate risk. Answer: C. Business risk, unsystematic risk. Business risk, also known as unsystematic risk, is the risk associated with a specific company or industry, such as a product failure or poor management, and this type of risk can be mitigated or reduced through diversification. By contrast, market risk, inflation risk, and interest rate risk are systematic risks that affect the entire market or economy and cannot be reduced merely by diversifying the portfolio. The core concept is that a mutual fund's broad portfolio helps to smooth out the negative impact of one specific security's poor performance. Question 34. A person who is subject to statutory disqualification (SD) due to a felony conviction within the last 10 years may only sell products that are not defined as securities such as fixed insurance products. B. Not be associated with a FINRA member firm in any capacity unless they receive a waiver from FINRA. C. Be associated with a member firm as a registered representative but not a principal. D. Continue employment as long as the conviction was unrelated to the securities business. Answer: B. Not be associated with a FINRA member firm in any capacity unless they receive a waiver from FINRA. A person is subject to statutory disqualification (SD) if they have been convicted of any felony or a securities-related misdemeanor within the past 10 years, which prevents them from being associated with a FINRA member firm in any capacity. This prohibition is absolute unless the individual successfully applies to FINRA for a waiver, which is granted only under extraordinary circumstances. The purpose of SD is to protect the public from individuals who have demonstrated a lack of fitness to work in the securities industry. Question 35. The practice of late trading of mutual fund shares is A. Permitted only by institutional investors with firm approval. B. The practice of executing orders after the close of the market at the current day's NAV. C. Permitted only if the order is received by the registered representative before the market close. D. The practice of executing orders after the current business day's close at the following day's NAV. Answer: B. The practice of executing orders after the close of the market at the current day's NAV. Late trading is the prohibited practice of accepting a mutual fund purchase or redemption order after the 4 p.m. Eastern Standard Time close of the New York Stock Exchange but still executing the trade at the current day's net asset value, NAV. Mutual fund share prices are calculated once daily at the market close, and any orders received after the close must be executed at the next business day's NAV. The clue is the current day's NAV for an order received after the close, which gives the investor an unfair advantage based on after-hours market news.